Here we go. Thanks for joining, everybody. I'm Steve Blumenthal from CMG. Joining me is Mike He, who runs research here at CMG, and Renee Canizin, Evolution Trade Credit Finance Fund. Renee, it's great to see you. Thanks for taking the time. Before we get going, federal securities laws require us to make the following disclosure. Investing involves risk. Past performance is no guarantee to future results. Different types of investments involve varying degrees of risk. Therefore, it should not be assumed that future performance of any specific investment or investment strategy will be profitable, be suitable for your portfolio or individual situation, or prove successful. No portion of this call should be construed as an offer or solicitation for the purchase or sale of any security. There are additional important disclosures in our Form ADV, which is available on our website, cmgprivatewealth.com. Okay. Agenda, Renee, is similar to what we do on all the quarterly calls. Personally, one of the things that I like most, which we'll get into, is just the update with you being on the front lines in the economy, being a bit of a macro economic geek. Curious as to what you're going to be seeing. So we'll get into that. If you could, as we start off here, give a brief summary of the Evolution Trade Credit Finance strategy, and then update us on progress through quarter end 2024 and anything else you might be seeing so far going into this year.
Sure. Great. Thank you as always, guys. Yeah, the just a quick recap for the fund. The fund is a short duration income generating fund focused on working capital solutions for our clients, our borrowers. I'll go into some of those product types, but the way to think about this is an income fund that is in the high yield credit market that focuses on working capital solutions for the client base. Those solutions include everything from factoring, accounts receivable financing, supply chain financing, inventory financing, other structured solutions, one of which is a relatively new product. I'll give an update to the group on that, which is called letters of credit replacements. These are all solutions for clients who are looking for short duration working capital. And we, of course, provide that and therefore earn interest income, which is obviously passed on to investors. A second important element of the fund is it also provides structured solutions to the supply chain, which tend to be in the form of a derivative contract, or we call it trade credit protection. And those transactions are unfunded in nature, which means they are transactions where we're providing effectively credit guarantees to the same clients for their use as well. So all related to the supply chain. And certainly I'll go into some of those transactions. But the way to summarize the fund is a mix of solutions-oriented products in working capital space for largely focused on the supply chain of U.S. credits.
Thank you. That's helpful. So talk a little bit about the yield distribution, how we finished 2024, fourth quarter also, and any forward guidance that you can share.
Sure. So the fourth quarter finished with I think it was technically a 14.1% annualized distribution yield, which is consistent with the previous quarter, which was also a 14-ish, I think it was also 14.1 distribution yield. And in fact, that could be our 8th consecutive quarter of in that range. I want to say the 8 quarters ago was close to a 13, maybe a 12.80 or something like that. And of course, the last 7 quarters after that are closer to the 14% distribution yield. So nice, consistent distributions continue for the fund. Certainly, do not expect any changes in terms of full guidance on that going forward in the first quarter that we're in today. But certainly we'll see as we finish the quarter. But that has been our target, and it's certainly nice to continue to realize that. In terms of the fund size, it did take on some new money in the beginning of the fourth quarter. The fund now is 168 million as of the fourth quarter end. We've took in another 26 million in January. So for the first quarter, so the updated fund size, when you'll see the end of Q1, will be about 192 million dollars of invested equity. So the fund continues to grow nicely, which obviously adds stability and helps our sourcing channel. But in terms of putting money to work, the fund continues to be fully employed. We finished the December 31 funded balance, which almost exactly of its paid in. So $168 million of funded positions. So virtually zero cash drag, which is always nice to see, which obviously helps the return profile. So a very strong quarter, 14 distribution, fully funded ramp portfolio. The fund continues to grow. I'll call it no watch list assets, all performing assets. Certainly everything we would continue on, and looking forward for the first quarter to date seems like also a solid quarter as well.
So when you talk about fully ramped, there's two elements to it, right? The first is the trade finance. The
Yeah.
second is the trade credit protection insurance. And then you've been steady in distribution. So what does when you're talking fully ramped, of course, on the trade credit finance side, that makes, I understand. Is that also, do you feel like you're fully ramped on the credit protection side of the book?
Yeah, so the credit protection side, we target a 50 to 75% leverage equivalent. So, for every $100 million, we would want to have 50 to 75 million dollars of trade credit protection or equivalent trades in the synthetic world. We finished the quarter at 60%, right in the middle of that range. So yes, so from that perspective, we had a full complement of derivatives alongside the funded positions for the fourth quarter.
Is there any movement in terms of SOFR, the base lending rate, is down 0.5% or so since the Fed, maybe 1% since the Fed is made their moves. Yet the return is staying the same. Are you seeing anything in terms of your ability to finance at levels that interest rates that you're interested in receiving?
Yeah, sure. I'll comment on two things actually, because there's the rates and of course the spread to SOFR that we're able to earn as well. That also can have variability. And in fact, if you looked year on year, we are down a full point really from, we've gone from a 5.25 probably a year ago to a 4.25. These are rough numbers. Technically you'll see Fed fund effective like 4.31 or something like that. So certainly the base rate has come in a fair amount, and I would also add that credit spreads have also contracted in the overall market. We'll talk about this business particularly, but in the overall market, you have seen a contraction of credit spreads as well, a function of a strong economy. A lot of money sloshing around still on the investment side. And a strong economy, and therefore credit spreads or we call it tighter, obviously, meaning they'll be reduced over time. So with both your base rate and your spread rate coming down, that's a lower yield. And so how does that affect us? Well, we certainly won't be immune to that over time. But I would tell you to date, our average yield continues to be in the funded transactions around a 14.5% overall yield, which is probably close to what it's been averaging for the last 12 months.
And that's a gross number.
That's a gross number, and that's gross unlevered, I'll call it. And then secondly, the trade credit protection trades, which are really a spread only equivalent. That's also maintained. This fourth quarter finished around the 12% spread in trade credit protection, which did give you guys some background. That would be pretty consistent also with the average over the last 4 quarters. So we haven't seen a material contraction or really any material contraction in either the funded or the unfunded. But I think it's a good question, Steve, because I do think that if rates persist low, certainly, and spreads continue to be tight, we could see some pressure at some point in our product set. Certainly to date we've been not had that, but we would anticipate some pressure at some point. But to date, it's been even into the first quarter, we have not seen it yet.
That's really helpful. Before we step into the economy, just one added thought to that is our base case is that as we work through sovereign debt and some of the challenges, big challenges that we have facing an end of the debt super cycle, which we believe we're trying to work through, and we're in the later innings of trying to get that resolved. And how it happens, I don't know, but our best guess is that it will likely lead to additional money printing, and to us that leads to inflation. So what we're after in general are strategies that if interest rates go up, SOFR goes up, our spread goes up. If interest rates come down, I hope we're wrong. I really hope
Yep.
we're wrong. But if we're right, we want to be in something that can increase yield in an environment of rising interest rate environment. Can you talk about that in terms of your fund?
Yep, certainly. And I'll even continue with your theme, to be honest, on my view of that. Thematically, I would highlight the biggest risk I see for everything that Evolution does, not just the short duration fund, but even our longer term debt solutions, is inflation. I certainly agree that not just the debt that's out there, but I actually also think things from tariff, tight labor supply. There's a myriad of things that I believe um, um, or adding to the risk of inflation. To date, it's been controlled, certainly, and certainly rates reflect that. In fact, if you look at the shape of the SOFR curve, so everyone thinks of SOFR as a short duration rate, i.e., 1 month, 3 months, 6 month. But there's a curve where you can look at the term structure of SOFR over time. And if you look at the term structure of SOFR, you can get a sense of what forward rate expectations are. And they're one very, very flat, meaning 4% in the 2 year, 4% in the 3 year, 4% in the 4 year, 4% in the 5 year. That's the actual numbers. Like they're literally within a basis point of those numbers. So the SOFR curve is very, very, very flat, and you can see it's slightly inverted from where we are today. So the market expectation still is of interest rates being, I'll say, consistent, steady, with slight chances of rate cuts going forward. So the market has not subscribed necessarily to the inflation risk, and therefore the higher rates that may come with that. So I think that's noteworthy. But I would agree, actually, that would be one of the things on my radar is one of my biggest risks. And I only answer the second part of your question was, well, how does that affect us? How does it affect what we're doing every day? And so there's two things about our strategy. One is it's floating rate, and therefore it's resetting SOFR. So if SOFR goes up, we will get the benefit in this fund portfolio of higher rates. But the other side of the coin of higher rates related to inflation could be its effect on companies, and therefore higher default rates coming from that. And therefore, what does that do to our portfolio if we have higher rates? Well, with higher default rates, you'll get something called higher credit spreads. So the spread above SOFR will also increase. Now, because we're in a short duration portfolio, we also can reset that as well. So one thing I love about this fund relative to funds which have longer dates in them is you're not only resetting SOFR, but you get to reset your actual spread to SOFR as you see fit on a client by client basis. So it lets you be a lot more nimble, and there's a lot less price volatility associated with a fund like this. And so we do believe we'll have that benefit. The downside, of course, is no one wants higher default rates. So certainly higher credit spreads implies higher potential default rates, and therefore that's something you want to be cautious about.
Mhm.
But the ability to reset your spreads relative to the risk of the market is very important dynamic, and we have that here.
Like that.
Hey, Steve, can I jump in with a question real quick?
Sure.
Sorry, before you move on to the economy. Renee, you mentioned no companies on the watch list. I think last time we talked, you went through some examples where there was maybe one or two that you were keeping an eye on. Did they improve in terms of your risk metrics, or have they aged out of the portfolio? Like
Yeah, I
what
think
happened?
I think yeah, I think you're referring specifically to trade credit protection relative to the funded trade. So let me jump in if I can
Right.
give a good kind of summary of how we think of those two, because we treat those product lines differently from um how do we employ our capital and our risk. So it's worth talking
Sure.
about. So in the funded transactions, they are larger transactions. And they are higher percentages of the portfolio. They generally range between 5 and 10% positions.
Hmm.
And therefore, those transactions are the ones where there is zero watch list and they're very steady and excellent. We also employ trade credit insurance on a number of those positions. And in fact, uh, probably 35% of the portfolio has trade credit insurance on it,
Wow.
which is quite high as well. So which makes them effectively quasi investment grade funded solutions. So from that perspective, high quality portfolio and very comfortable where we are. In trade credit protection, those trades are much smaller. In fact, we have as many as 50 different obligors
Mhm.
in that side of the business. And so because of that, you have positions which are, $250,000, $500,000, up to
Right.
$1 million. In those positions, therefore, we take a lot more risk because they're so small in the
Hmm.
portfolio, and we get paid a lot of premium. We
Hmm.
expect defaults in that portfolio. We run that portfolio expecting to have defaults over time, and they generally will be dwarfed by the amount of premium we collect, which
Hmm.
is why we like that business line. So I said
Right.
earlier, we're collecting as much as 12 points of premium per annum,
Right.
and our loss rate in that business line, even pre this fund's existence, has been something to the tune of 15 basis points per annum. That's the
Wow.
firm-wide
Right.
loss rate
Hmm.
relative to collecting 12 points of premium, right?
Right.
So that's 0.15% to
Right.
12%. So a very high returning asset class. So we do run that portfolio with the expectation of of um, of having watch list assets. So I just want to
Gotcha.
clarify.
Okay.
And they do work themselves out. Either we let them age out because they're
Right.
on our watch list, or we have a default, one or the other. So I would give an update in the first quarter on that, but I don't believe there were any fourth quarter defaults this quarter.
Right. Okay.
Yeah.
Thanks.
Hey, can I come back on that for a second? Because you hit on something that's really important. I'm not sure that
Yeah.
everyone understands. So essentially, two parts of the portfolio, you're loaning to trade finance, and then you've got this credit protection that you're writing. So you're taking risks, you've got this exposure. But you're also, let's say you write protection against a default of Macy's, for example. Somebody selling shoes, I always use this example to Macy's. And if Macy's keyword files for Chapter 11 bankruptcy, then the whole credit protection you've offered kicks in, you take the responsibility, you get it. But you're also doing something else in that you're able to offset some of this default risk that you're taking on, this counterparty taking on, where you're going to other larger insurance companies, and for a very small expense, and you can explain what that means,
Mm.
you're buying protection on the protection you're giving. So if something happens to, I think that that's really important in
Yep.
terms of the risk exposure to what you're doing with the strategy. So
Yep.
I'll pause there.
I'll talk about that. That's great. A
Mhm.
great segue, Steve. So we generally will be buying protection, as you say, on some of our risk, and we do that actually on the funded side of the business. So if we are doing a supply chain financing facility, which we have, for example, for Novum Energy, which is a Houston-based energy physical trading house, we actually have trade credit insurance. It's called TCI, trade credit insurance, where we have a policy or policies. We actually have more than one, where we will have protection such that if Novum Energy has a failure to pay on its receivables back to us, we can make a claim to that insurance company for protection, and the claim is for up to 90% of what's owed to us. And so there is a whole industry called trade credit insurance, which we take advantage of. Steve, to your point, we actually then take advantage of that on the other side, and we write protection in that trade credit protection business profile. But they won't necessarily match in the names that we write protection versus we buy. We generally buy protection on our funded trades because those are the large blocky trades we have, the 5 to 10% positions. The trade credit protection that we write, because it's generally smaller, those are not protected.
Got it. So are you able to somehow pool your portfolio of, let's say, the trade credit protection that you write, or even for that matter, some of the direct lending on the finance side? Are you able to pool that and buy insurance in aggregate as pooled assets against
So
the portfolio?
we have two, yeah. So we actually have two types of policies. To your point, we actually have um, a syndicated insurance policy where we have named obligors, people we want protection on. And so we have a policy which is with 4 insurance companies participating, which is syndicated among the 4. And they cover a series of names, let's call it 6 to 7 names for us, with policy limits per name with an aggregate policy coverage. Away from that, we also do single name policies where we buy protection specifically with one insurance company on one specific name. We might go to Allianz, which is the biggest insurance company in trade credit in the world, and we might buy a policy from them on First Brands, which we do, and we basically have protection on First Brands supply chain financing transactions with Allianz Insurance. That would be an example what we do.
And you're receiving X and you're paying out a fraction of that.
Yeah, those policies are very cheap. I'll give you, a benchmark. They can change over time, but we pay something between 75 to 80 basis points per annum, and
Wow.
we're collecting 15 to 16 to 17% yield. So you can imagine the amount of money we pay relative to the yield is de minimis.
And you haven't seen too much of a fluctuation in what that cost structure is that they're charging you. That stays relatively steady.
That's been pretty steady over the years, actually. So the answer is yes, it's been steady for us. But to give you more color about the market dynamic, it really hasn't moved in years. That's kind of the going rate. It's a competitive market for trade credit insurance, and therefore they need to compete with each other, and they keep their policies relatively steady. And in fact, trade credit insurers will say, similar to my comments earlier, they expect losses. They don't run their business on a zero loss threshold. So they will compete. They will be competitive in their premium to try and win business. They're okay. They're okay having some portfolio losses because for them it's a volume business.
Wow. So why don't they come in and compete against you?
Because they don't do funded, right? Because it's the liability side of their balance sheet. So if you think of what an insurance company does generally, right, is that they are writing protection, whether it's, by the way, it could be protection for homeowners insurance, protection for auto, protection for fire, but they also write protection for trade credit insurance for receivables.
Okay.
And so for them, it's just part of their contingent liability stack. As you guys know, what is an insurance company model is to earn premium, then take that premium and invest it in investment grade assets. That's what insurance companies do, right? They take all those premiums earned and they run a portfolio that's generally highly liquid, by the way, because that's statutory required, and highly high investment grade. And to give you a proxy, I bet you 70% plus of an insurance company's premiums are invested in investment grade assets, to give you a sense.
Wow, that's helpful. A quick interruption here. So for attendees, at the bottom of your screen, there's a Q&A box. I do see there's one question in here. I'm going to pull that up and It's more of a comment than a question. No sound. Emmett, thank you. I hope it's all working for everybody now. But feel free to type in a question if you have one, and we'll read it out to Renee.
Renee, I've got one for you.
Yeah.
It kind of is a segue into your view on the economy, but I see your business as you're helping your clients manage risk, right? Credit risk, timing of cash flows, et cetera.
Yeah.
Is there, and as risk gets elevated, which you alluded to earlier, that's an opportunity for you for the fund. Is there a sweet spot in terms of like environment? You mentioned that risk gets too high, and then default rates go way up. So is there a sweet spot in terms of the risk environment, and what have you seen over the last, call it 2024, relative to the first couple of months of the Trump administration? Has the risk environment at least has the opportunity set changed in any way?
Yeah. It's almost like where's the Goldilocks scenario. So I appreciate
Exactly.
that. Maybe I'll give you bigger, and then I'll get to your smaller question, right? So bigger is, the truth is we've had a low default rate since the Great Recession, right? We really haven't had a spike in defaults in some time, even including COVID, right? If you think of what happened during COVID, you had a little bit of a delay of a spike in defaults, but it was very short-lived.
Right.
So let's call it inside of 12 months, And if you look at something called the trailing 12-month default rate, which is usually what you'll get out of Moody's and S&P, you'll see with small spikes over that time period, it generally came back in line pretty quickly. And where we are today is pretty consistent with the historical default rate. So historical default rate in high yield is generally roughly around 2%, give or take 0.5%, 1.5%, 2.5%. If you want to include other quasi defaults, restructuring of debt outside of bankruptcy and things of that nature, maybe you'll add another point to the default rate, and it maybe goes from 2 to 3 or something, right? But generally, we've had a pretty mild default experience for some time. The answer around, well, what's ideal for us? I'll give you we've done some historical work on this, which is when default rates are highest versus when they're lowest, relative to the return experience when it's highest and lowest. And so what do I mean by that is the lowest default rate vintage was actually when the trailing 12 months was the highest. So you're like, well, how can that be, right? So if you look at 2009, the 2009 default rate was literally through the roof. It was 10% default rate, whether you look at bonds or loans, right? But any debt that was originated in 2009, so even though the default rate was 10%, if you made a new loan while default rates were 10% in the year of 2009, and you followed that vintage for the next 6 years, I think there was one default out of 100.
Right. Oh, wow.
Right. So
less risk, not more risk.
Yeah. Right. And by the way, that 1 out of 100 is not to be thought of as 1%. It's 1% over 6 years, which means the default rate was like basis points, right?
Yeah.
And so you can see,
20, right?
Yeah. So you can see right away, what does that tell you? It tells you when the market is the scariest, the underwriting standards are the tightest, which makes sense, right? That entirely makes sense. But yet you're yielding the highest spreads with the lowest risk, therefore, because spreads are the highest when they're backward looking, and yet the vintage is the best. So I would encourage everybody, when you think about credit risk, especially in term debt, when the default rate is spiking, you have the best terms, the highest spreads, and likely the lowest default experience. So that's how you should think about credit. I'm
going to show a screen real fast here. Okay, do you see this? The yield curve?
Yeah, I could see that.
Yep.
Okay. So effectively, what you're talking about is we're all the way, let me pull this over. We're all the way at the far right. 2.78% is the option adjusted spread, meaning
Yeah.
you're really not getting paid very much to take the risk in
Yeah.
this case, in the general high yield bond market. And you were talking about '09.
Yeah. So look at '09. See how wide
Mhm.
those spreads are? And then I'm
Yeah.
telling you, the loss experience was almost zero.
Right.
So what a home run you would have had, right? You had the
Well,
widest
yeah.
spreads and lowest default rates, which is counterintuitive in terms of efficiency of market, but very intuitive when you know why.
And look at
Mhm.
what you were touching 2.5% just a
Yes.
handful of times,
Yes.
and where we are basically touching it again. That's
Yeah.
amazing.
Yeah.
Okay.
So that's a great graph for pulling that out. So anyway, so my point, hopefully I know it's a little long-winded for you, Mike, but I think it's
Yeah,
really
no, I
interesting
appreciate you
data.
highlighting.
Yeah.
I mean, I'm thinking about, investors and what their concerns might be,
Yeah.
which may be counterintuitive to what their experience is going to be.
Yeah. Yeah. So now for us as a fund manager, I kind of love it when spreads blow out because that's when you can get your best, your
Right.
best risk reward
Right.
and the tightest terms.
Mhm.
That's really great. I've been trading
Yeah.
high yield since 1991
Mm.
with funds, and
Yeah.
there's just no juice in the strategy at this
Yeah.
point.
Yeah.
You're just not getting paid for it. So I resonate with that. When
Yeah.
things are worse, it's when it's best. Here's
Yeah.
a question from Elliot. Can you give us a worst case scenario reference, let's say '07, '08? What might happen to the fund? In the past, I think you said maybe a zero return if you double the default rate that we had back in '08, '09. Can you comment on that?
Yeah, so I'll comment this way. So one of the benefits of high yield in general, right, is the actual return profile spread plus base rate uh, is generally high enough to offset increasing defaults when they occur. Now, of course, as you mentioned, that can certainly will reduce your total return, but usually it does in a way that you generally will not be principal eroded.
Mhm.
So to give you guys a great example, if you look at virtually any 5-year cohort in the high yield index's life, and I mean run it every year, 5 years, every year, every single year. So don't have any prejudice in running it. You literally won't be able to find a negative return. In fact, I think if you run it for 3 years, you might find one negative return period. And why is that? It's because the coupon is so high that it dwarfs the default rate to what it costs they can get to. It would have to have a very persistent default rate for some time. And so one of the benefits you get from a high coupon, high yielding asset is you get some coverage when things go wrong. So now I'm going to go to your question. I think it was Ellie who asked, is
Mhm.
you're going to get the same effect, right? You're going to get the same effect that we're returning, something in the close to a 14 yield distribution here. When defaults happen, and they do happen, they will happen, as they say, right? At some point, you will be have hopefully a muted protection, muted impact ultimately to any kind of principal loss because your coupons should start to overwhelm your potential payout. So an example is if you have an event and you have a 3% position defaulting on you, the coupon being what it is, within a couple of quarters, you've made that back up, right? So within 2 quarters, you've made up that potential principal loss. So you should be able to offset that very quickly. That's what you're gearing towards, of course, in this fund. And I'll clarify for everyone's benefit. People use the word default rate, but you have to have loss too, right? So it's really loss after default, which we care about. So if you have a 3% default rate and you have a 50 cents recovery, you really only have 1.5 cents loss, right? So it's a function of what your loss experience is. Certainly, we hope to have a high recoveries if we have any loss experience, default experience, but nonetheless, the coupon is your balancing act here that should help offset potential losses.
That's really helpful. And you touched on something there that's if you lend money in a trade receivable loan to a vendor and they default on you, you then receive the paper. So you may have had it protected with your, extra insurance, but you receive that. And then in the capital stack, as it works itself through bankruptcy, you sit at the higher end of the recovery. stack. Can you talk about that? Am I
Yeah.
right in saying it that way?
Well, it actually depends. It actually depends, and I'll give you some examples of why it depends. In many cases, and I'll give you guys an example of what happened just in the fourth quarter. If you guys saw in the month of December, at the end of the fourth quarter, Spirit Airlines filed bankruptcy. And I believe it might still be in, it might be coming out shortly. And therefore, if you were a debt holder to Spirit Airlines, you have an impairment. Even the first lien loans in Spirit Airlines were trading, I think, as low as 50 cents on the dollar, which would imply there's going to be some impairment to the loans at some point. But yet the receivables, the vendors who had shipped goods to Spirit, who then owed receivables, were made whole. What does that mean? They actually were never impaired because in the bankruptcy filing, to keep Spirit Airlines as a going concern, they decided not to impair its vendors and to keep paying them at 100 cents on the dollar. So that goes to your comment, Steve, is that sometimes and often receivables are treated senior, in this case, to the or on I'll call it on preferred terms than the first lien lenders were, whether the bond or loan lenders. I would caution us, though, that doesn't have to be the case. There's no legal requirement, and therefore you may be subordinated as a receivable holder. In which case you are then at the bottom of the stack because they've decided to impair you. Okay, and if you want to use something that's well known, everyone knows when J.C. Penney's defaulted a few years ago during just post COVID. If you were a vendor of J.C. Penney's, they gave you zero money back, right? They didn't. There was no recovery on your receivables. So I'm giving you the extremes of 100 and 0. Of course, you can imagine over time it could be someplace in the middle, right? Depending on what the client does. But hopefully that's helpful. So there are times when you're, we call it preferred in your treatment, and there's sometimes when you are not treated that way.
Okay, perfect. Thank you for that. Peter asks, capacity, meaning will you reach a point, do you think, where you cap the fund? As it grows, do we run risk of being diluted in terms of return? Your opportunity to find investments that produce the return.
Yep. So certainly, growing a fund is always a balancing act of, as he points out, to ensure you don't dilute your return profile, but also you want to grow the fund so it's meaningful to the market, right? Because that helps your origination channel, right? The bigger you are, the more transactions you can win. So there's a stability factor here you're always trying to balance. The primary answer to that is that's why we actually not only grow the firm, but we also try to grow into new product lines which fit us. So if you guys don't mind, this is a great segue to talk about a new product we just brought on in the fourth quarter, which will show you how we've been growing our ability to put money to work in the fund. And so there's a new transaction type, which I referred to earlier as letters of credit, LC for short, LC, letters of credit, LC replacement trades. And these letters of credit replacement trades have many themes to them, because letters of credit are used in the market as guarantees, as their name might imply. In fact, in Europe, they're called letters of guarantees. They're called LGs, but LCs, LGs, letters of guarantee. They're used to provide credit support to corporate clients. And so, as you guys know, what Evolution does for a living is we are credit risk takers for the corporate market as well, right? So this is right up the alley of what we do for a living. And so we are able to provide letters of credit for corporate clients to guarantee their performance in a way that lets us expand the investable universe. And we have a number of these transactions now where we have provided letters of credit guarantees for large corporations. You'll see them in the portfolio. One of them is called Tenneco, which is in the portfolio. We provided a letter of credit guarantee. We also then provide the cash is provided to the bank as support for the letter of credit. And we have therefore artificially created a working capital short duration risk of something that's equal to the balance you receive from the bank. Let's call it SOFR, Fed effective, plus the premium that the corporation pays me for providing a letter of credit. Let's call it a spread of 800 basis points. So we've created a SOFR plus 8 asset, which is a 12.5% yielding instrument plus fees, get closer to a 13, with a 1-year duration, which is therefore a short duration. So what we're able to do is expand our product set beyond inventory, accounts receivable, supply chain financing, and now with letters of credit, creating synthetically a working capital facility for our corporate clients, which are very high yielding and we think have great risk return dynamics. So I'm going to go into that. It's going to be a little complex, so we can do it on another call as well, Steve, I promise in the future. But let me give you the high level benefits of what we love about this business line. Is we're not all letters of credits are made equal. So what are we guaranteeing for this particular client is relevant to how much risk we're taking. We know that the first line of defense is the client doesn't default. If a client doesn't default, it doesn't matter what we're guaranteeing. We obviously have gotten paid without having to have impairment. That's a good thing for us. That means the full SOFR plus 8 comes back to us. There's no impairment. But because we're not actually funding the client directly and just guaranteeing someone, the client actually has to have his guarantee drawn after he defaults for us to have any loss. Similar to trade credit protection works, where even if our client defaults, we often don't have a loss because there's no claim. Well, these letters of credit have a similar dynamic in that even after a default, there may not be a claim under the letter of credit. And in fact, we would suggest from the uses that we're using today, we have found the history is there's very little history of claims on these letters of credit, even after default of the entities. And so that's what we love this business line. And I'm going to give you now a specific. We're actually started doing these trades for something called workers' compensation insurance. And that's effectively where we are posting a letter of credit to an insurance company on behalf of our corporate client. And if that corporation defaults and does a restructuring, the history is that the letter of credit doesn't get drawn because the company has to restructure in Chapter 11. It continues to pay its insurance premiums in Chapter 11, so it can reorganize and come out the other side. And because he's incented to maintain his insurance in filing, there's no draw ever on the LC. So we feel we've created a business line where we are getting paid high rates of return, which are equivalent to bond level yields, and to be frank, even higher. Low duration instrument, therefore no rate or spread risk, in a method which has a high recovery upon default. And that's why we love that line of business.
How would you size it in the portfolio as a percentage of risk exposure?
We would do similar to the funded trades. So in that 5% area.
That's really great. So that brings in new asset, more diversification.
Exactly.
Yeah.
Exactly. And we think a very high recovery asset. We think a very high
That's
recovery
great.
asset.
Well, I know we're moving through this pretty quickly. This next question from Dan is timely because I do want you to briefly touch on Echo 3. All right, so wanted to thank you for the excellent work, all you are doing. This goes to you, Morgan, and team at Evolution. What is next for Evolution in terms of new funds and future plans? Many of our clients have an understanding that Evolution Credit Opportunities Fund number 3 is coming. We will need to set up a feeder in order to be able to provide access to that. The minimums are large and to go direct. So we don't need to go into that now, or we can touch on it. But could you just talk a little bit about Echo 3?
Yeah.
And also how it feeds the broader universe of how we benefit in Evolution Trade Credit Finance?
Yeah, actually, that's a great second point as well, because it's a huge issue, huge benefit to how we operate at Evolution. So we operate as one united platform across the firm. We don't think about a specific fund sleeve. We actually approach our clients with a menu, and then we try to sell those menu items to our clients, and then appropriately allocate throughout the platform. The benefit of that approach is we have a more robust origination engine, right? Because we're more useful to the client by showing a fuller menu. And secondly, it helps you determine better risk reward trades across the firm, and therefore you as a fund participant have more comfort that we're not, I'll use the word forcing a trade, doing the trades that makes the most sense for the fund, right? And so we love to approach the market that way, and it's been very helpful. So our flagship fund, which is a credit opportunities fund, which feeds many of these strategies we're talking about today, just launched a successor fund called Echo 3, Evolution Credit Opportunities Fund 3. The Fund 2, which finishes investment period in this past December. Inception to date is done a 21 net, so very high yielding fund, of course. That would be certainly a top decile fund and higher in its for its vintage and its fund type. And this successor fund, Fund 3, just did its first close a few weeks ago in mid-January. So we took down investor commitments of $470 million. And we are doing a subsequent close in a week or so, and then at the end of March. And so we will have close to, if not exceeding, $600 million of commitments in this new fund, Echo 3, as of the end of the first quarter. That fund will be open for the year. It'll be open from March through December 31 for new commitments, targeting $1 billion fund size of commitments. That fund also will target similar return profiles we had in Echo 2, of course, and it's does a broader array of transactions than this working capital fund that you guys are in, because that's really just a short duration fund. This does a broader array of transactions, both term debt as well as short term, as well as synthetics, etc.
Wow, that's great. Helpful. Thank you. Do you think you're going to be your best guess on timeline to be fully funded at $1 billion in the fund?
Well, I think we'll be open for most of the year, but I have to say it was a very strong first close. I hard to predict certainly, but I suspect we should be open for most of the year.
Okay. Well, I'll have to circle the wagons here
Yeah.
and get timing and fund structure in place. Would we be able to, if we had something set up for, let's say, end of March, we've got a lot on our books. That could be tough, but if we're potentially, well, I can talk to you offline. I want to get a sense of what we can do timing wise and make sure that we can deliver that it all is good for everybody.
Yeah.
Okay, let me take a look, see if any last. I've got a compliment from JP to you.
Thank you.
So that's nice. And Mike, any last questions you can think of?
No, I'm good. Thank you, Renee. I appreciate your time and answering all the questions.
Great. Thank you as always, guys. I always appreciate it.
Yeah,
Thank you.
thanks so much. It's fun, and we learn a lot. Thanks so much, Renee.
All right, guys. Take care.
Okay, take care.
All right, cheers. Bye-bye.
Bye-bye.